Dave Reeves, Managing Director, Calidus Resources. Calidus is a gold producer in Western Australia. Stage 1, 90,000 ounces per annum, building up to Stage 2, 130,000 ounces per annum. We're in our commissioning and ramp-up phase as we speak. Lots of good exploration potential around us in the East Pilbara, and we're also looking at spinning out a lithium, for our ownership of the lithium company, which we've put together in the last year.
Dave, good to see you again. I saw you back in May, and thanks for coming back on the show. So interesting times, interesting markets out there at the moment. Who would be a gold producer in this market? Inflation hitting your bottom line. How's it going out there?
Well, look, Aussie dollar terms, the gold price has pretty well stayed stable for I don't know how long, a long time down at 2,500 to 2,600 range. And I think sentiment is driven by US dollar gold price more than Aussie dollar. So certainly from an equity value proposition, the whole across the gold sector in Australia, it's been hammered probably down 30 to 40% over the last 6 months. That's across the board. And a portion of that, I think, is to do with inflationary fears, but a portion of it is purely sentiment. Inflation, I think it's made up of two components. There's real and transitory. Real inflation is the labour that we've increased our pay scales and you don't get that back. Transitory is things like diesel and explosives price. As energy prices come off, they will come back. And in particular for us, we've just switched over to LNG for our power station, so that's taken a lot of our diesel burnout as well. But so some of that inflationary pressure I see coming off, and that obviously helps margins.
So for companies like you, when you're doing in this kind of ramp up phase of production, right? And I assume you're going to you're aiming towards hit your end of year guidance here. The market's looking for surety around specific variables, specific data points. Costs affect your bottom line, obviously, and margins. What are the things that you point the institutional guys to, or you point the retail guys to and say, look, fundamentally, we're getting a lot of this right. The transitory stuff will fall away. Some of it won't, but we will make adjustments.
Yeah, so look, we haven't put out a lot of data regarding costs and other things in the marketplace just yet because we are in an operational ramp up. But certainly what we're seeing is cost-wise against our budget, we're tracking very well. No major surprises there. There's been some of those ramp-up costs, like we've been running on diesel, not LNG, and that's now out of the way, etc. I think the cost side is one, and to get a margin, it's the revenue side, obviously. It's very pleasing to see our grade control model. Grade is reconciling very well to our resource model. We had a good quarter, the June quarter, with reconciliation through to the gold bars that we've put out. But there is more work to be done there. We've got quite a bit of COVID still going around. We still get locked up for 7 days down here, and we're sitting at 15% to 20% of our staff at the moment off with COVID. And as soon as you get a key staff off, we've only got one explosives truck operator on site at once, and if they're sick, you don't blast. You've GMs down, our processing managers down. So, there are a lot of challenges in maintaining, I suppose, production to feed the mill and supervision of that revenue stream. So, that's probably one of the main issues that we face at the moment is just personnel.
But you're right, because it's not just personnel, it's key personnel in key roles, which can stop. It's kind of like organising the holiday roster. If you've got one guy who's in charge of driving explosives truck and he's on holiday, there's going to be no blasting while he's away. So what do you do in an environment like this where you're still dealing with COVID in Western Australia? It seems quite draconian still, whereas the rest of the world is just taking the view of it's discretionary. If you want to get on with it, get on with it. If you don't, fine. How do you plan for that? Because that could affect 2 weeks, 3 weeks worth of operations in some cases. So what are you doing about that?
Yeah, look, it's very challenging. In your example, a guy going on holiday, if a person's going on holiday, you can plan to bring someone in. You've got advance warning. With COVID, they test positive on site, get locked straight in their room for 7 days. you don't have spare capacity on site. You don't have backups for all these key jobs. Two reasons: one, cost, but second, scarcity. You know, we've got a very tight labour market here in Australia with these skills. So you just can't have people. There just aren't people floating around. So then you've got to scour the state or Australia to see if you can do anything. Or worst case, you've just got to wait till they're out or the next person comes in on their swing. So it's what are we doing about it? We have a lot of protocols on site to try and minimise spread, and it was all going very well. But you get one or two people who maybe don't do the right thing and get a bit ill and don't tell people, and before you know it, it's wildfire through camp. And as you said, with our measures in Australia, we have to isolate people, whether they're showing symptoms or not. We then test the whole of site. If there's problems, they get locked up.
Wow. Okay. Good. So things like that, it makes it a tougher planning environment for operations, right? In terms of driving efficiencies. That said, when I kind of push CEOs on these sorts of topics, and especially when it's things like inflation hitting the bottom line, they're saying, well, we can eke out efficiencies elsewhere. We're looking at this, that, and the other, and we might be able to, hopefully not have things affect the bottom line so much. Which begs the question, why weren't they doing that in the first place? Because it should be a constant thing that they're looking at. So for you, if I look at things like cost of staffing, employees, contractors, etc., do you genuinely think that is not transitory? In the past, pre-COVID, you would have said, markets kind of rise and fall, and what you have to pay people rises and falls depending on availability. But the scarcity is coming from what? People just not coming into the mining sector?
Oh yeah, it's a whole range of things. Firstly, people not coming into the mining sector, the younger generation. It's probably a sector that isn't top of their list of things to do. Even though you can get into lithium and all these other things that the world needs for greening, it's still considered not a very green industry and not something that attracts a lot of people. Our borders have been shut for a couple of years, and Australia is there's a massive migrant intake each year, and so a lot of those skills haven't been coming in. And if you have a look, on our site, we've got people from all around the world. We've got people from Sri Lanka, from China, from Africa, from UK, from Pacific. It's everywhere you can draw skills from, we're drawing, but we've had none of that inflow. And we've been going through a bit of a commodity boom. All the prices have been up. There's been a lot of projects constructed and across the whole board. It's not just mining, I suppose. You talk to anyone over here in Western Australia in particular, we've got a few percent unemployment. So you name it, from having your local barista through to our explosive truck operator. There's just no flex in the numbers at all.
Okay. Well, we're in danger of getting sucked into the good old days conversation, right? So let's come back to you. Okay, you are in this ramp up period. You haven't kind of released figures. Will you complete this kind of ramp up to optimum state by the end of the year?
Yes.
Okay. Will you at that point then release the numbers and give people a sense of how you're doing and what your expectations are for 2023? Yeah.
Oh, absolutely. We'll obviously do quarterly reports.
Okay.
And once we declare commercial production, we'll provide guidance for the year ahead. Once we've got some confidence in those numbers, so that'll all be coming.
Okay, because we need something to kind of judge your performance by. So the ramp up is a kind of like a steady state. Hey, we're producing cash, and here are the margins, which gives a sense of comfort. But the bit I wanted to talk to you about today, you've got to raise some money, not a big chunk of money, $20 million, right? And you talk about that to fund growth projects. What's that actually mean for you?
Yeah, so the way debt works is we've got to achieve various performance hurdles, 3 months performance tests. And, as we've alluded to the market, we haven't been milling at full capacity due to some constraints and with COVID and maybe not mining it where we need to be. And we need 3 steady months to get that ticked off. We need to fill up things called debt reserve accounts with the bank. So a lot of our cash, apart from paying off debt, goes into these other accounts, and we can't access any excess cash until we've passed all these performance tests. So we're not going to see cash back from the operation till sometime in, first half of next year. So we could either sit on our hands and do nothing and chew into mine life, or go to the market and shareholders and say, hey, this is the situation, so we can sit on our hands, or we can raise a bit of money and get cracking. And that's what the market showed very strong support for is growth. So we're going to be out there drilling again for gold down at Blue Spec, Marble Bar, at Klondike. We've got a whole program planned and ready to go. So we're just finalising drill contracts now. We've the 20 million has allowed us to engage on discussions on looking at satellite deposits around us and how we'd fund drilling, and whether we need to put any funds into achieving some form of input into those projects. And then we've got the lithium as well, where it's not core, but we certainly see good value in it. We've told the market we're going to spin that out into a separate company. So we'd like to add some more ground in, do some more exploration, and add more value before that gets let loose. So all of these things, this 20 million gives us the ability to do, whereas otherwise we just couldn't have done anything.
Right, it gives you the ability to talk about a lot of different things, but it doesn't. They don't necessarily all have the same value. Dollar for dollar spend value. So what's important to you? Is the spin out more important than going finding new gold, given that you've already got a decent sized resource? I mean, how do you value these things yourself?
It's more about what's actually happening on the ground. Do we have decent targets we think are worth drilling, firstly? And we certainly do for gold. There's some pretty exciting stuff, especially to the west of Blue Spec, we want to crack on with. If we can find some more 16-gram ore bodies, that's manna from heaven. So that can add real value. The lithium, don't have a resource or anything like that. We've done some scout drilling, assays coming in. That's got a long way to go. So there's value in lithium, and everyone's excited about it, but it's not the same value as we have in gold. And I think, it's a very good question. It's very hard to determine where it goes, but we've got budgets for each that we think are appropriate for the company from a medium and longer term for value add, not just immediate short term.
Right. Okay. So can you help us with that? Just understand that phasing, because obviously you bought Blue Spec and you spent some money on that. You paid a chunk of change away to Novo Resources. So surely you've got to focus on that. That seems like the quick win here, or is it?
So feasibility is coming out this quarter on Blue Spec. Looking at starting early works. There's some accommodation units we've put our foot on nearby, some secondhand mining kit for underground coming from nearby, that if we can just quietly start to accumulate that, it can save us a lot of money from the capital we're predicting. And obviously with inflation, capital has gone up, so certainly with the fees we'd expect those costs to be going up. So anything we can take our time and put our foot on for something with a lot of savings, it's well worth doing. So that's certainly something we need to do. We still have to permit Blue Spec. That's gone in. But again, back to the old labour shortage, it takes time. It's taking 2 times as long, if not more, to get things permitted. But we want to have things ready to go when we decide it's time to press the button.
Right. Okay. And then talking of sort of putting yourself in a position to produce more cash, as it were, the Warrawoona Mill expansion. Now we've seen companies like Warrawoona Resources buy a second mill in their district quite cheaply. There was a good spend of money, I think. But with the expansion right now, are you going to be able to feed that? Have you got enough that can go through the mill to kind of produce this additional cash? Would that be a good use of money right now in this environment?
Oh, absolutely. So we're not talking a lot of money for what we're looking at with a mill expansion, because in our fees we said 2.4 million tonne per annum for transitional, 2 million tonne per annum for fresh. We think on a blend we can keep it running at that 2.4 to 2.5 million tonne per annum. So short term, not a huge benefit, because the first year and a bit were forecast to be transitional. But as we start getting into fresh, the tonnage doesn't ramped down. We were building large stockpiles under the previous scenarios. This just allows us to produce more cash. Again, more of a medium-term win, but again, it all takes time. You don't just grab these things off a shelf. Some of the pumps and screens and other things, it takes time, and with shipping, it all takes time. So making sure they're in place so when we're in the fresh or starting to get fresh into our blend, it doesn't wind our tonnage back.
Right, but would you need to raise additional capital to actually make that happen?
So that was part of that growth capital.
That was same, right, it's in there. Okay.
Yeah, so we're talking a few million dollars for that.
Okay, so that probably seems like a good use of capital, kind of set yourself up. And because it's one of those funny things now, as a producer, I sort of jokingly said who'd be a producer in this environment, because it seems better to talk about sort of fluffy concepts than actually mine at the moment. Where you talk about the potential of the future, where you guys have actually got to deliver the answers and keep hitting your targets. And in a way, it's kind of bizarrely harder, even though you're throwing off cash, isn't it?
Oh, look, it's unrelenting from here in that, being an operator, especially, during commissioning where you're finding out all the little hiccups is normally hard enough. But in the middle of COVID and labour shortages makes it a lot harder, and the market is unrelenting in its requirements. So, you've got to build trust with the investor base that you can deliver. And once you get into the swing of things, life becomes a little bit easier. But then the market just says, well, what's next? What's your growth project? So you do have to be doing both at once and achieving well on both.
You absolutely do, because growth is the number one key component here. It's got to drive that share price. Like you like many other gold producers, and especially in Western Australia, have been hit over the last few months, irrespective of what you do. So I think that's the sentiment component. But production wise, you've ramp up phase, great. You've got $20 million to kind of look at this kind of this expansion growth component to it. We have talked in the past about M&A, and I don't know whether you're just sort of tipping your hat to it because all company directors need to say these things. Yes, we're always looking, but right now, do you think you've got your plate full?
Oh, we're pretty full. Having said that, I think assuming operations bed down over the next few months, and we can take a little less focus on that. The lithium spin out is ongoing, and when that spins out, there'll be less on the plate. So early next year, I think it's also interesting having a chat with some corporate types earlier today, and I think we all agreed that the equity markets are getting tougher, and a lot of these developers in particular that need another 30, 40, whatever million to get them through to feasibility. They haven't been, let's say, as open to discussions as you would think. And I think as that tap slowly winds down, if that equity drip, dries up, then conversations can become a lot more real. And, I think you don't want to rush into it another 3 to 6 months. If the current markets continue for juniors, then I think a lot of boards will be reflecting on, how open they are to these M&A discussions.
I think it's interesting. Obviously, I think, having built in the time frame that you have, especially built the infrastructure, and I'm looking at a picture here on my screen of the site, you get a little bit more credit in the marketplace for saying, look, we know how to build mines, we know how to get into production, we know how to operate. That helps in terms of future available cash, because there seems to be a lot of marginal projects left a little, as I think you're indicating, stranded at the moment, as a question of, do we see another 2020 happen again where projects get financed irrespective of what the team is and what the project looks like? Or is the dawning realization that mining's going to be operating in a very different environment going forward? Are you finding people, are the bankers approaching you yet on those sorts of conversations? Because they've got to deploy capital. That's how they make money.
Oh, they do. And look, we always get approached on M&A ideas, and everyone's always open to funding good ideas and what have you. But we need to look at what we think is best for shareholders. And we've all suffered, but I think the developers are starting to suffer a little bit more in some ways as that equity market tap slowly screws shut. And it's a combination of that and will. If the will is not there to transact, you don't want to go hostile ever. It's too hard. And I think there's a mindset change that needs to happen from these 2020 days where show me the money, I want 20, I want 30, I want 40, and the money rolled in. And now they say I want 10 and, well, here's 4. And you're not going to get anywhere with that. That's where the opportunity lies for people like us in 3 to 6 months.
And what do you think about the gold producers specifically? Because it has, in the past, I think, had a lot of competition with Bitcoin conversations going on, and even sort of people moving off to technology. Both those things have come off wildly recently. But there is this move towards this kind of, greenification. The battery metals seem to be flavor of the month, so to speak. Do you think gold projects are going to struggle going forwards, or do you think that this insatiable demand for gold will come back again?
So, as with everything, it's down to price. Like coal was on the nose 3 years ago. Now coal is, everyone loves coal again. No one would mention it, but now all these investment funds are going back into coal because of the profits that are coming out. So the same be with gold, is that should price go up and should we hit stagflation or any of the other things? And the world is not in a good spot with its economy. So, in bad times, gold does well. Are we approaching one of those times? I'm not an expert. I read a lot and I just get more and more confused. But all I know is that, it's a very volatile world, and the chances of gold doing very well, I think, are pretty good. And if that happens, love comes back pretty quickly.
Crikey, I can't believe I'm about to say, how much worse does it need to get? Because it seems like right now, if you describe today's environment to gold investors 10 years ago, they'd have gone, right, that's Armageddon. So gold will be at whatever they say, 3,000, 5,000, pick a number. But it hasn't happened. So I'm just wondering, are the rules the same? That's the kind of question I'm asking myself as a gold investor. I'm like going, are the rules the same today as they were 3 years ago, 5 years ago, 10 years ago? And I'm kind of unsure.
Totally unsure. But, with yields, bond yields going up, going down, 2-year to 10-year crossovers happening and yield inversions. And, it's so volatile at the moment. I think that's probably the issue, is that no one can see clear direction. Once there's clear direction, I think that's where the opportunity lies with more the generalists getting into the gold space rather than just the gold bulls. But at the moment, it's, you look at what people are saying about the equity markets and the Fed, that it's going to be a soft landing, it's all going to be good. And then out comes the Fed and says, no, we're going to really hammer this. And mood changes overnight. And I think without the clear economic indicators, sentiment alone is not enough for gold price.
Okay, I was just going to finish up on, I want to come back to the growth fund projects side of things again. Okay, current life of mine, 8 years, right? ASIC, 1290, nearly 1300. Those are the things that people are going to be looking to you to reduce. You want to, people looking, so is that Aussie that I'm looking at as well, 1290, or is that US?
Yeah, that's Aussie, and that's, we're saying guiding 10 to 20% increase on cost, call it 15%.
Right.
On that, so that 1500.
So brings it to, okay, US, okay, cool. And then
1500 Aussie, which, US is about 1,100.
Yeah. Okay. So you're getting towards that 1,000 mark, which is good. So they're looking to that, and with the ways that you're going to be able to reduce that, obviously increased throughput will help. So on that, you've described, where that potential increased throughput could come from with the mill and extra feed and the fresh, etc. But 8-year life of mine for institutions is a little kind of tiny little red flag at the moment. So how quickly do you think you need to, or will you be able to kind of indicate an increase in the life of mine?
For sure, and that's why we raised the 20 million to get out there and start drilling. You're not going to add life of mine without turning the drill bit. So, I'll be cracking on that later this year, and we've got some low-hanging fruit we can target. I suppose some of the stuff we're doing at the moment is a bit more greenfields, just because our geos are super excited about what they're seeing on the ground. And as I say, there's life of mine, and then there's 16 gram ore bodies as well. So, it's, again, a balancing act where you need the bulk to keep the life going, but you need that sweetener as well to get those ounces up.
Okay, so Dave, just in summary, then, what's your assessment of the year, and what have we got? What's the phrase? What have we got to look forward to? That's it. Get there in the end. Okay, here we go. Okay, Dave, look, just in summary, I appreciate your time today, but your view of this year to date, and what have we got forward to look to?
Yeah, so what a fantastic year. When you look at it, we've built a gold mine, we're producing gold, pulled together a great team that's doing an exceptional job in very trying conditions. Our mill can produce above tonnage than predicted. The recoveries at 98% are superb. Mining, when we're not short of COVID people, is hitting its straps. So huge amount of positives have gone on to date. We need to finish the ramp up and do what we say it says on the tin, and that's what we're focused on now. And then looking ahead, we're back to drilling the exciting stuff. Let's see what's out in the wilderness. We've got some amazing targets. We've got the lithium spin-off. We want to add more ground to that. So we see some real value add coming from those growth projects once we bed down this first phase. And it's all in all, I think, been a really good year, and looking forward to finishing it off strongly.